Welcome to another episode of Bulls, Bears, and Blockchain on Revolution Radio, making smarter financial decisions with your host, Rob Nelson, former Fox News host and anchor at Roundtable Media with his team of market masters, Mark Lepresti, Managing Director of Moneta Advisory Partners, co-founder of Battlefin, leading data platform, and a former institutional equities trader at Lehman Brothers, Alex Massioli, founder of Trade the Chain, former head of institutional prime brokerage at Bequant, John Nigerian, co-founder of Market Rebellion, former co-host of Halftime Report on CNBC, and co-founder of Option Monster and Trade Monster. Daily data insights and ticker updates direct from three of the world's top TradFi, legal, and crypto experts on Bulls, Bears, and Blockchain every Monday and Friday on all your favorite platforms. Let's get started.
Good morning, good afternoon, and good evening. Wherever you are, whatever time zone you're in, you're listening to Revolution Radio's Bulls, Bears, and Blockchain. I'm your host, Rob Nelson, and I've got my team of market masters, John Nigerian, Marc Lepresti, Alex Massioli, and special guest Tom Essaye from the Sevens with his weekly global macroeconomic perspective. So in our Monday show, John, Mark, and Alex, you each have 3 picks for us that you want us to look at. John, you give us 3 options pick, Mark 3 stock picks, and Alex 3 crypto picks. And of course, we have our Put Your Money Where Your Mouth Is and our B3 Index Challenge. John, why don't you kick us off with your top 3 picks for the week?
All right. Thank you, Rob. I'm going to go with, ChargePoint. That's CHPT, as the name implies. This is involved in the same sector as Blink and many of these technologies that are used to help charge vehicles and so forth. So 10,000 of this Friday, which would be the 17th of February, upcoming, expiring 12:50 calls. They're about $1 above where that stock closed or thereabouts. And so I like the trade. We do see lots of volume in this name in particular, Rob, day in and day out. So it's very active on the option side. Another one would be Johnson & Johnson, J&J. The 24th of February, so this one you really get 2 full weeks, this week till the 17th, and then the following week till the 24th. They're buying puts in here that are about $6 below the market. So that's a bearish trade. Lastly, we had a trade that I thought was pretty interesting because Kohl's, KSS, also had bearish activity. And these are March puts. They're the March 2750 puts. And that is with the stock trading at 32.37. So they're $5 below where the market is. That's a very bearish bet. And they have earnings due on the 7th of March. So you don't have to wait too long, basically 3 weeks, let's call it, to see whether or not they stink it up with the earnings or if they have some other thing that they have to announce between now and then that causes the stock to move to the downside. So I've got 3 bearish trades, Rob.
Interesting. And 2 of them, Kohl's, like the department store that won't die, like JCPenney, Sears, whatever. And Johnson & Johnson's been around since, I don't know, long before I was born. 2 old school and one sort of cutting edge tech side. I mean, a question on that, John, you're picking a pick that's for charging vehicles. We're going to see a lot of stuff around electric vehicles that aren't auto industry specific, right? Because you could almost argue Tesla's a tech company.
Right, absolutely. And yet you need to get electric vehicles charged, and Tesla has a bunch of superchargers out there, but then you've got to find other places when you don't want to just depend on Tesla. So Blink charging is one, and its biggest competitor other than Tesla is probably ChargePoint, CHPT.
Awesome. Okay, 3 bearish options. Marc Lepresti, you got 3 good stock picks for us, and feel free to comment on one of John's if something hits your buzzer.
Far be it for me to take the opposite side of a trade from the very talented Dr. J, who taught me a good part of what I know. And I've got a couple of bulls and a couple of bears for our listeners this week. Let's start with a bull. It's reporting on Valentine's Day, and investors are hoping that love is truly in the air for Airbnb. This is a stock that's done very well since finding its most recent bottom in December, up about 40%. And we're expecting Airbnb, when it reports earnings on Tuesday, to tell investors, both through the guidance and through the numbers, that it is enjoying the significant tailwinds that we have seen drive the travel industry in general, with those explosive earnings and earnings guidance from airlines and other travel names. Part of what we like about Airbnb, Rob, is that this company keeps a lot more of the money that it makes, because most people go directly to the Airbnb site as opposed to going through Booking or Expedia. And it's actually trading currently at a pretty low valuation, around 48 times GAAP earnings. But when you look at it based on an enterprise value and free cash flow basis, which takes into account its cash balance and free cash flow, it actually looks even better with an EV/FCF, as that indication is called, of about 20. And here's the best part. In a higher interest rate environment, Airbnb actually does better because it collects interest income on the money that it gets from customers between the bookers and the owners of the properties. In fact, in the third quarter of last year, Airbnb generated almost $60 million in interest income alone. So we're feeling pretty bullish on that stock as it reports earnings on Tuesday. The second thing I'll point out, we're going to be looking very carefully to see if the party in the energy sector continues. Of course, the energy sector leading Friday's S&P leaderboard, up almost 3.5% overall on Russia's news to slash its oil production by about 500,000 barrels a day. So a lot of the names that were up almost 5 or 4.5 points are going to actually be reporting next week, like Marathon, Phillips, and Devon Energy. We're feeling fairly bullish on the sector because we think that the indications on the earnings from these names in energy, particularly in oil production, we're going to be fairly positive even prior to this news from Russia on Friday. And so we're expecting to see further strength in the energy market going into next week. The last one I'll mention is a bearish call on Beyond Meat. This is a company that I have been relentlessly bearish on. I've talked about it on Fox Business and other shows. John, we got a very interesting bearish put roll indication from the Unusual just yesterday, and Beyond Meat is reporting earnings on the 23rd. We see this stock going continually into a bearish position into earnings, and then we'll see where we are on our next show before Beyond Meat reports on the 23rd. So those are my three for this week.
Question on the first one for you, Mark. It's interesting you talk about, travel and the travel sector. And it's a fascinating point you make about Airbnb and the high interest rates environment benefiting them. If you were just to sort of pick a part of that sector other than Airbnb that you think is likely to be positive and one that's likely to be negative in the travel space, what would it be? Or do you think the entire travel space is going to keep bumping up?
Well, it's interesting, Rob. It has been something that has defied my expectation. When I was looking on another show, I won't mention which one, in mid-August, talking about my outlook for the travel sector, it was fairly sanguine. I was not expecting to see the numbers coming out of the airlines, Delta chief among them, that we saw, and the resiliency of the travel sector took me a bit by surprise. Some of the rental car names have had more volatility for a variety of reasons, more related to their business model than strength in the travel sector. But we think the travel sector strength overall is expected to continue.
Great, thank you. Good stuff as always. Alex, you're up. What do you got? What do you got in the crypto space for us?
Well, I mean, we're hanging on here after getting a bunch of bad news over the weekend from the regulation standpoint, and crypto is going through a frantic phase of flight to quality now, I believe. That, coupled with the fact I just got an alert that we just shot down a UFO over Canada. I don't know where the world is going to these days, but I will say volume in crypto is light, 50% of what it was a week ago. when we recorded that episode, sitting at 35 billion, and we're precarious at the 1.02 trillion market cap. My 3 picks for today, generally I swing trade. I like to do interweek trades. I'm going to go with 2 longs. Not saying that I won't short them and try to scalp some profits, but I'm going to pick Ethereum. We've hit the 1500 mark on Ethereum. I like it. If anything, I'm walking away from the Gensler news with just another opportunity to buy, load up on my position. We're 7% up on the month for Ethereum. I like it at 1500. I'm adding to my position. Optimism, I've spoken about it before, ticker OP. It's up 72% for the month, and I am going back into it again. Again, these 2 are going to be longer duration trades, and I will notify if I do an exit. The 3rd is going to be a swing trade, I hope, in my favor. And that's going to be Origin Trail. I did mention this a couple of weeks back as well, ticker TRAC. It's up 134 for the month. Sentiment is piling on, and I like it. There's enough excitement where I think I can eke out a few percent in profit over the next couple of days.
You talk about taking Ethereum. Do you think Ethereum's kind of hit whatever, I don't want to say whatever bottoms, there's no such thing as what bottoms could be, but I mean, you're feeling in the short term it's going to keep going up? Or again, you said it's a longer term play, but there was a lot of down in the last couple weeks. I mean, for Ethereum and Bitcoin.
There has been a lot of down. And, I'll reiterate what I said about 3 weeks ago, which is I don't believe we're going to go. I believe the bottom's in. We've been hit with enough bad news, and the market seems to be responding positively to it. 92 billion, that's a number I don't want anybody to forget. That's the amount of profit that staking is making in the United States on exchanges. And Gensler's going after it, may go after Coinbase next. I don't think the market is going to go down tremendously on that. We've proven a lot of resilience now. I think it's been tested 3 good times in the last 6 weeks. I'm ready to call the bottom and start moving upwards and onwards.
I like it. It's a great analysis of it too. And again, to everybody listening, we're not telling you how to invest. I want to be really clear about that. We may be doing these investments. We're giving you our best advice on the market and the market space. You do what you want with that. That's just my full disclaimer. Educational purposes only, but it's good stuff and it's good insights. I'm constantly making notes. And Tom Essaye is with us again today. Tom is the founder of the Sevens Report, a leading global macroeconomic research report. Every day, Tom does 7 trends you want to follow. For us, he does 3. Tom, great to have you with us. What do you got for us today?
Thank you again for having me back. So something really interesting happened last week in the markets, or really over the past 6 trading days, ever since the jobs report. And is that bond yields have screamed higher. So the 2-year Treasury yield is up nearly back to the highest levels of 2022. 10-year yields up nearly 30 basis points, yet stocks haven't gone down. And the big question in that is why? And the answer is because economic growth is strong and the market thinks inflation continues to decline. So as we look forward to this week, those 2 assumptions have to be proven true if the market is going to stay as resilient as it's going to be. So that makes Tuesday's CPI report easily the most important thing of the week. The market needs to see that number come in at or below expectations to sort of reinforce that disinflation is continuing and that we're not seeing a bounce back in inflation. The next 2 most important numbers this week are going to be your Empire Manufacturing Index and then your Philly Fed survey. Okay, those are the first 2 economic reports of every month. They're the first 2 economic reports of February. Markets are going to want to see stability. Why? Because they need to know that growth is solid. If growth is falling off, right, if we see a sudden deceleration, but all these bond yields are back up, that's bad news for the market. They will not be able to stay this resilient. We will see a return to volatility.
Thanks, Tom. I want to jump into something with all of you. I've sort of pieced together a lot of the picks and things you said, and I'm going to back this up against Kathy Woods, because John, you've been talking a lot about Kathy Woods and art, and I watched a fascinating interview with her on Mornings with Maria on Fox Business, and she said a lot of what you're saying, but a couple things that it tied into things we're actually talking about. One of them was the idea that, and Mark, you mentioned the energy sector, and Tom, you mentioned bonds, was the idea that commodities and bonds both are suggesting that inflation really may be on its way down. And Tom, that's what you're alluding to. Is it or isn't it? John, Mark, Alex, your thoughts? I mean, it makes sense that could be an indicator that inflation isn't going to keep going up. But what do you think?
It's absolutely true. Inflation isn't going to keep going up, but that's not the point. The point is how quickly it goes down. None of us think that inflation's going to keep running and going back towards perhaps even double digits. I don't think anybody's saying that. But if we're stickier around the 6, 5, and so forth percent levels, that's going to be problematic for the Fed because their target is 2. Now they'll try to fudge that. They'll try to say, well, we can tolerate 3 or even 4 for a while, but it can't stay there very long, which is true. But the issue will not be that inflation's falling so quickly that we go right through to. Instead, it's going to be how sticky it is up here at these still elevated levels. But again, none of us are saying that it hasn't peaked or that it's going back to the highs. I haven't heard a single person say that.
Yeah, listen, on our side, I agree with John on what that outlook looks like. We just need to have the Fed stop raising interest rates at such a dramatic pace with inflation coming down. Now I'm hoping for an intersect where, we're not going to see them drop rates, but at least pause or slow down. I'd be curious on hearing what Tom's view is, especially this early in the season or this early in the year, on where he thinks his prediction of rate raises would be through the 4 quarters.
Hey guys, so I have been of the opinion that the Fed is more hawkish than the market appreciates really for a while. And the sole basis for that opinion is that they know the mistake that was made in the 70s, right? The mistake that was made in the 70s was they stopped too early. They got cute with 25 basis point cuts, and then they had to come back in. And they ended up turning in what should have been a 2-year painful period into an 8 or 10-year painful period. They will not make the same mistake again. They'll probably make a new mistake whereby they're going to over tighten. So I would think that we're going to get another 50 basis points. I don't think inflation is going down in this straight line like everybody, kind of hopes it is. It is going down. John is absolutely right? It's not going to bounce back. But at the same time, it's not going to go down in a straight line either. And I think that may take the market by surprise. I think the Fed goes at least 50 more by year end.
Devil's in the details. The devil's in the details. So is the success in the markets. Let me ask you guys about the tech company layoffs. We've done a lot of talking about how all the big tech companies are laying off. And on the one hand, you could argue that's a bad thing, or it's a sign, that they need to contract. But obviously, so it could be a good thing for their ultimate bottom line. But if you look at it, right, wouldn't it be fair to say that a lot of them expanded during COVID? I mean, how fast did Zoom grow? From what was it, to 20 million to 200 million? I mean, these companies expanded, and wouldn't it make sense that now they're retracting their workforces, and that's not necessarily a sign that a big sign for the economy as much as a adjustment? It's not a sign the tech sector is in a slowdown, or is it?
I'm of the opinion that you're going to have standard expansion and contraction across all industries, right? We're highlighting the tech industry because COVID made everybody very tech focused because you're sitting at home alone. Companies like Zoom had uber growth during that period. The same with a lot of innovation tech companies, including, the Googles and the Microsofts. I think it's, traditional contraction that we're going through to meet market demand. And I think you're seeing that across other sectors. I just think it's outlying in the tech sector because of COVID.
Well, Rob, I think it's more than a COVID thing. I agree with Alex, but we talk about this concept of the Great Resignation, right? Which represented or was created, that term was created to reference this sort of dramatic change in the behaviors of employees, the dynamic of employer-employee relationships, where the power was really put in the hands of employees, right? It's part of why the employment numbers continue to come in as strong as they have been week after week, notwithstanding the Fed's efforts to have the opposite impact on the employment picture. And those changes related to the Great Resignation started before COVID. were catalyzed and propelled even further by COVID, like so many other economic and macroeconomic factors. And what the tech industry did, it's widely agreed, was it overhired. It got ahead of itself, not necessarily to keep up with COVID propelled demand, but to try to get ahead of the competition when it comes to those coveted, highly skilled tech workers who were even more in pole position as a result of all of those factors of the Great Resignation. So that's what I attribute it to. They hired way too many people than they needed, not just because of COVID, but because of that change in the employer-employee dynamics.
So, and I guess my question is that contraction back is necessary and it's an adjustment that's ultimately good for their bottom line and their shareholders. But some people have argued it's a sign that the space is contracting in a bigger way, that like it's not going to continue to grow as much. Would be fair to argue it probably will. I mean, it's this is not a bad sign. It's probably a healthy sign and not ultimately like, oh, we're about to burst the bubble.
That's right, and that's why you see actually some of these tech names perform quite well on the announcement of these layoffs. I don't see. I'm curious if Dr. J agrees. I'm pretty sure. I think he doesn't, but I don't think we're going to see any sort of significant contraction in tech. In fact, in certain sectors of tech, we see expansion and still attractively priced equities.
Yeah, I agree, Mark. Just last week, of course, we had Disney announce 7,000 or more employees. Everybody's doing it. It's not just tech. I suspect that a lot of them are doing it to clear the books, not necessarily of last in, first out, LIFO, but rather getting rid of people that they can't get rid of during normal times, whether it's because of age, sex, or anything else. People that just weren't pulling their weight, perhaps, and they don't have too many opportunities other than right now to address that. And I think most of them have done it in tech. And because of that, even though all of these layoffs come at a cost, it's not like you can just lay them off and you don't have to pay. You're giving severance to virtually all these folks. And I think that will not be as significant, since most of the big tech companies have such significant revenues. I don't think it'll be a significant cost to them. Nonetheless, it'll be 50 to 150 million in most of these tech companies' cases. And that's just one less thing that they'll have to worry about in the quarter after that, Mark. So that's helping lower the bar for them for the next quarter.
Hey, John, quick question for you. You've been very bullish. I mentioned before on Kathy Wood's ARC, and it's taken some hits as would be expected. I'm assuming you're still bullish, but my question that I wanted to ask you is, people have suggested that's sort of the new Nasdaq, and I think that's an interesting idea that like a heavily driven tech fund ETF like that is possibly seeing things that the traditional market indexes aren't picking up because of who is in them. Can you talk about that for a second?
Well, her ARK Innovation ETF, the ARKK, as we said last week, biggest one by far is Tesla in there. And when Tesla traded up, when Mark said he wanted to, stick with it, and it was a good call, and the Tesla ran to 212 and a half, I think, something like that. Obviously, the ARK ETF worked really well that day as well. And it peaked, I think, last week at about 43 and a half or something like that, but then sold off with the rest of the market and with Tesla. So I think she's got a very volatile portfolio, but it's not much more volatile than the spider for tech would be in the S&P 500. But it's definitely going to be more volatile than the NASDAQ itself or the S&P 500 because you've got so many fewer stocks in it. It just, by its very nature, it has to be more volatile.
Same quick question to you, Mark. Do you see, again, that idea of it's the new Nasdaq, that there are that having a number of these companies that are in the Nasdaq may be missing the bigger trend that an ARK innovation type fund would pick up, and that there's an underlying truth to that that's important for investors to be looking at beyond ARK?
Well, I mean, if they weren't, then you could just trade the Nasdaq related instruments, right? So there has to be a purpose. There has to be alpha that's being offered by investing in these ETFs, like ARK, that you can't get someplace else. And that's one thing that we always advise people in considering investments into these ETF products is what's the alpha? What are you getting from this investment that you can't get someplace else, perhaps at a lower price point relative to fees? Yeah, I do think there's a lot of validity behind the concept of what these ETFs are trying to deliver. It just is a question of whether or not they do. And of course, I agree on what John was saying in terms of the inherent volatility. When you have these kind of tech names and a smaller number of these tech names versus the index, of course, you're going to have more volatility.
And Alex, one last one for you before we get to our "Put Your Money Where Your Mouth Is" segment, my favorite part of the show. I know it's been a rough week in crypto, and I know I talked to you on Roundtable the other day, and you were like, "Yeah, I'm not as optimistic as I always have been, although long term." But isn't it for all the the Charlie Munger, the 100-year-old billionaire, kind of coming out and saying crypto should be banned? Is it fair to argue that if for no other reason than crypto as a way to diversify portfolios for big institutional players, there's no way ultimately crypto's going away. It's going to weather its storms, but it's a valuable asset class to hold. But if you just even argued to diversify, that big portfolios will want to diversify with it.
Yeah, absolutely agree. And I thank you for not asking me about ARK. I do believe it's a great way to diversify. I think if if you're smart in putting a certain portion in the blue chips, and like I said at the top of the show, crypto is going through a flight to quality phase right now. And so that's what people really need to respect. Obviously I do a lot of gambling on the side with some small cap stuff, but that's me for my money to lose. For the regular folks, I say stick to the blue chips, stick to the things that you can understand when you do your own research, and it'll pay off. I'd love to lay down, Bitcoin performance or top crypto performance over equities and see how it does balance out a portfolio. That's my take on it.
All right, awesome. Great stuff from everybody. All right, we're just about out of time, but we always have time for "Put Your Money Where Your Mouth Is."
This week, I'm going to go with IYR. You've got 2 weeks out, basically, Rob. 5 days this week, 4 days the next week, because there's President's Day in there. But the February 24th expiring 90 puts in the IYR, that's going to be put my money where my mouth is, U.S. real estate shares ETF.
And Mark, your overall index is up solid, like 50%. You've been picking great overall, and you went with Raytheon last week. What are you going to go with this week?
Well, this week, Rob, as I talked about at the top of the show, we're going to go with Airbnb and hope that love is indeed in the air for Airbnb when it reports on Valentine's Day, Tuesday after the close.
Hey, let's hope love is in the air, in the bed, and in the breakfast. Alex, what do you got? What do you got for us this week? And again, it doesn't have to be a crypto pick.
Yeah, no, absolutely. But it is. We had a great reversal happen that made prices attractive. I'm adding to my positions in Ethereum for my midterm, and that's my trade. I like it.
Great show, everyone. And for everybody out there listening, be sure to check out our website. It's revolutionradio.io. There you can actually see and track the trades made by John, Alex, and Mark. And you can also keep an eye on our B3 index and how each of them are doing with their "Put Your Money Where Your Mouth Are" picks. Great job, guys. It's Bulls, Bears, and Blockchains. Have a great day. We'll see you guys next time.
Today's episode of Bulls, Bears, and Blockchain is proudly brought to you by Verijet, the only solution for short-haul private aviation. To learn more, go to verijet.com, and we'll see you in the clouds.
Thanks for joining Rob Nelson, Alex Massioli, Mark Lepresti, and John Nigerian with another great episode of Bulls, Bears, and Blockchain, twice a week on Revolution Radio. Whether you're new to the world of Web3 finance or an experienced investor, we've got you covered. Follow us on Twitter at GetRevRadio and visit our website at revolutionradio.io, helping you make smarter financial decisions.